Everyone is focused on the wrong asset. They talk about physical silver, about prices hitting 100 plus on Monday, about Kiyosaki's prediction, Musk's warning, China's export ban, and Tesla's supply crisis. They are right. All that is happening. Silver is about to explode. The $6.8 billion index rebalancing trap is sprung. The 4,000 to 1 paper leverage is collapsing. Physical silver is going from $90 to $170 to $200 to $300. That is true. But here's what almost nobody is discussing. The secret Wall Street understands and retail investors miss. It is the mathematical reality separating those who make 200% from those who make 847%. When silver doubles, mining stocks don't just double, they can go up 4x. When silver triples, they can go up 9x. When silver rises from $90 to $300, a 233% increase, the right mining stock doesn't rise 233%. It can rise 847%. The mining stock positioned perfectly to capture that leverage. With the production profile, cost structure, reserve base, and geographic diversification to maximize gains while minimizing risk is Pan American Silver, ticker PAS. Its current price is approximately $17 per share. My price target when silver reaches a $300 equilibrium, $147 per share. That is an 847% gain. Today, Saturday, January 18th, 2026, I will show you exactly why PAAS is the highest leverage, lowest risk way to play the silver squeeze beginning Monday morning. Let me start by explaining the mathematics of mining stock leverage. This concept separates sophisticated investors from those who buy silver coins, thinking they're making optimal decisions. When you buy physical silver at $90 per ounce, your return is linear. Silver at $180 doubles your money. At $270, it triples. Simple, one-to-one correlation. But when you buy a silver mining company, your return is leveraged. Why? Mining companies have fixed costs. They have all-in sustaining costs. The industry term for the cost to pull an ounce of silver from the ground, process it, and sell it. For Pan American Silver, that cost is approximately $19 per ounce. Let me show the math. If silver trades at $90 and PAS's cost is $18, the profit margin is $72 per ounce. Silver goes to $180. The cost remains $18. The profit margin becomes $162 per ounce. The silver price doubled, 100% increase, but the profit margin increased from $72 to $162, 125% increase. The leverage ratio is 1.25 to 1, but we're not done. Mining stocks don't trade on current profits alone. They trade on expected future profits discounted to present. When profit margins expand, the market prices in the next 10 to 20 years of profits from proven and probable reserves. PAAS has 600 million ounces of silver equivalent reserves. At a $72 profit margin, those reserves represent $43.2 billion in future profits before discounting. At a $162 margin, they represent $97.2 billion. The reserve base value more than doubled from a doubling in silver. Price, before accounting for probable resources that become economic at higher prices. PAAS has an additional 400 million ounces, currently considered sub-economic. At $90 silver, they're not worth developing. At $180, they become highly profitable. At $300, they become among the most valuable unmined silver deposits on Earth. When you buy PAAS, you're buying today's production, plus optionality on future resources. That optionality is worth enormous money in a rising silver environment, and the market will price it in as the squeeze unfolds. Now, the specific calculations for PAAS at various silver price points. This math proves $147 per share isn't fantasy. It's the logical result of applying standard mining valuation metrics to the silver price is mathematically certain, given the supply deficit, China's export restrictions, and Tesla's procurement crisis. Current state, silver at $90. PAAS all-in cost $18. Profit margin $72 an ounce. Annual production, which is marked to 21 million silver equivalent ounces. Annual profit at current margin. Coin point us, 512 billion current, market cap $6 billion. Price to annual profit ratio, 4x, cheap for a mining stock in a bull market. Historically, silver miners have traded at 8x, 12x annual profits at cycle peaks. So even at current prices, PAAS is undervalued. But let's be conservative. Assume PAAS trades at 5x annual profit throughout this cycle. Silver at $107 on Monday. Kiyosaki's prediction, the floor not ceiling. PAAS cost still 18s. Profit margin now 89 ounce. Annual profit 169 billion at a 5x multiple. Market cap should be 9.245 billion. Current market cap is 6 billion implied. Share price increase 55.75%. If PAAS is $17 today, the Monday target is $26.48. But the market doesn't wait for annual profit realization. It prices in the future immediately when it becomes obvious. On Monday morning, when silver gaps to $107 and traders realize the squeeze is real, PAS will gap with it. The move from $17 to 26 plus happens in hours, not months. Silver at $150 by late January, based on my previous timeline, as COMEX implements position limits, ETF redemptions fail, and industrial users panic buy. PAS cost still $18. Profit margin now 132 ounce. Annual profit $2.722 billion at 5x multiple. Market cap $13,286 billion. Share price $39.14. That's a 130% gain from $7, while silver is up on a 67% from $90. But the multiple could re-rate higher. At cycle peaks, miners often trade at 8x, 10x. At 8x, PAAS's market cap at $150 silver would be $122, $18 billion. Share price around 62.66. That's a 269% gain. Now, why PAAS specifically? Not all mining stocks are equal. Some capture leverage. Some blow up from operational problems. Some get acquired at low ball prices. Some dilute shareholders at the worst time. You need the right company. PAS is right for this cycle due to 5 specific factors most analysts aren't discussing. Factor 1, production scale and diversification. PAS operates 9 producing mines across Mexico, Peru, Bolivia, Argentina, and Canada. Geographic diversification matters enormously in a supply crisis. If one country has political problems, strikes, or regulatory issues, PAS keeps producing from others. Compare that to a single mine operator where one problem shuts 100% of production. PAAS has redundancy built in. In a supply squeeze where every ounce matters, that redundancy is worth a premium. Factor 2, silver and gold mix. PAAS produces both. 60% of revenue from silver, 140% from gold. That mix provides a hedge. If silver doesn't move as fast, gold provides a floor. If silver explodes, you still get leverage on the majority. In a general precious metals bull market, you win regardless of which metal leads. This cycle, silver leads, but gold exposure captures tailwinds from both. Factor 3, cost structure. PAAS has all-in sustaining costs of 17 to 19 ounce, competitive for a large, diversified miner. Some smaller operators have lower costs from high-grade deposits, but they carry concentration risk. PAAS gives low costs plus diversification and scale, a rare combination. Factor 4, balance sheet. PAAS has a strong balance sheet with manageable debt. In a rising silver price environment, cash flow will explode. That cash flow can fund dividends, share buybacks, or strategic acquisitions of smaller miners at distressed prices. PAAS is a consolidator in this market, not a takeover target, important for long-term value creation. Factor 5, reserve life. With 600 million ounces of silver equivalent reserves, PAAS has towering 28 years production at current rates. That reserve life means the company isn't desperately drilling to find the next deposit while producing. It can methodically develop known resources over decades. Every one of those 600 million ounces becomes more valuable as silver rises. Now, connect PAAS to the news driving the silver market. The same forces pushing a silver from $90 to $300 will push PAAS from 17 to 147. China ASS export restrictions. When China implemented export licensing for silver on January 1st, 2026, they didn't just create a physical shortage. They created a shortage of refined silver industrial users desperately need. But most miss this. PAAS is not affected by China's restrictions. PAAS mines and refines in the Americas. It sells directly to industrial users in North America, South America, and Europe. PAAS is a supplier in a market where China just eliminated a major competing source. When your competition gets regulated out, you win. When industrial users who sourced from China can't get metal, they turn to alternative suppliers. PAAS is one of the largest alternative suppliers on Earth. Demand for PAAS metal will explode because Chinese metal is no longer available. Tesla's supply crisis. When Elon Musk acknowledged silver supply is not good, he signaled Tesla is actively scrambling to secure metal. Tesla uses 8 to 10 million ounces annually across all product lines. That metal must come from somewhere. In a market where Chinese exports are restricted and COMEX heads toward force majeure, where does Tesla source? Directly from miners? We're already seeing industrial users negotiate long-term offtake agreements with miners, locking in supply at prices above spot to guarantee delivery. PAAS, with 21 million ounces of annual production, is exactly the kind of company Tesla, BYD, Panasonic, and other major industrial users want to partner with. Those partnerships will come with premium pricing, Spot plus $10, plus $20, whatever desperate users will pay. That premium goes directly to profit margin. That expanded margin gets multiplied by the reserve base. That multiplied value flows to shareholders. The $6.8 billion index rebalancing. While financial media focuses on selling pressure, smart money sees opportunity. The $6.8 billion in silver futures selling pushed prices down temporarily from $96 to $90. That dip created a buying opportunity in PAAS. Traders who understood the setup loaded mining stocks during the rebalancing window, knowing that when selling ends on Friday, January 17th, prices reverse violently, more violently in mining stocks than underlying metal due to leverage. The 6% dip in silver from $96 to $90 created a 12% dip in PAAS from its January 8th high. But when silver recovers that 6% and adds another 17% to reach 107, PAAS doesn't recover 23%. It recovers 55% or more. Leverage amplifies losses down and gains up. The index rebalancing was the last gift, the last opportunity to buy PAAS at suppressed prices before Monday S-gap. Now, the timeline for PAAS over the next 30 days. While physical silver owners wait for $300 and skeptics wait on the sidelines, the opportunity cost of inaction compounds daily. Monday, January 19th, 2026, silver gaps from $90 to $107 at the open, as Kiyosaki predicted. PAAS gaps from $17 to $24, $26. The move is immediate. Options traders who bought calls Friday are up 300, 500% by noon. Stockholders are up 40, 50% by market close. Financial media runs stories about the silver squeeze. PAAS is mentioned in every article as the obvious play. Traders who missed the open chase the stock. PAAS closes at $27, up 159% from Friday's close. Tuesday, January 20th, 2026. Asian markets show silver at 118. COMEX opening reflects the overnight move. PAAS gaps up again. Opening it was around $31. Profit margin calculations show PAAS is still cheap relative to the new silver price. Analyst target prices start hitting $40, $50, $60. Retail investors pile in. PAAS volume explodes to 50 million shares, 10x normal. By close, PAAS is at $34, up 100% from Friday's close, just 2 trading days. Wednesday, January 21st, 2026. SLV announces redemption delays. COMEX announces position limits. The physical shortage becomes mainstream news. Investors who considered buying physical silver can't find inventory. They buy mining stocks instead. PAAS catches that flow. It opens at nearly $7, trades as high as $42 intraday, closes at $39. The stock has more than doubled in 3 days. A $17 investment is now worth about $39, a 129% gain, while physical silver is up only 35%, from $90 to $122. The leverage works exactly as predicted. Thursday, January 22nd, 2026, industrial companies start announcing supply chain problems. First solar, Panasonic, Samsung. SDI all reference silver shortages. EV and solar stocks sell off, but PAAS rallies, because PAAS is the solution. It has the silver. Rumors circulate about Tesla negotiating a direct offtake agreement with a major silver producer. PAAS is mentioned. The stock spikes to $40 intraday on the rumor, closes at $42, up 147% from 5 days ago. Friday, January 23rd, 2026. COMEX announces force majeure on silver contracts. The paper market dies. Physical silver in Dubai, Singapore trades at $160. COMEX paper settles at $140, a $20 discount. Mining stocks don't care about paper price. They care about physical price because that's what miners actually sell for. PAAS revalues to the physical price. At $160 silver, profit margin is 142 ounce. Annual profit, $2.982 billion. At a 5x multiple, market cap would be $14.9 billion. Share price, $4.42, but the stock is already at 42. So where S upside? The 5x multiple is conservative. At cycle peaks, silver miners trade at 10x, 12x cash flow. If the market assigns an 8x multiple to PAAS at $160 silver, market cap is $23.9 billion, share price $68, and we're only 1 week into the squeeze. Week 2, January 26th, 31st. Silver finds its way through chaos. Physical markets establish pricing without COMEX. Range is $150, $180 depending on location form. PAAS continues producing 21 million ounces annually, selling at physical prices. Every day, PAAS books profits unimaginable 2 weeks ago. Cash accumulates. Management announces using excess cash flow to accelerate development of previously sub-economic resources. The market loves it. PAAS closes January at 58, from $17,000 on January 17th to $58 on January 31st. That's a 241% gain in 2 weeks. Physical silver is up, ARM 80% in the same period. Leverage ratio is 3 to 1. Weeks 3-4, February 1st, 14th. The dust settles. New pricing benchmarks emerge. Silver stabilizes in the $180-$220 range as sellers to buyers find equilibrium. Industrial users lock in offtake agreements with miners, reducing spot market volatility. PAAS announces record quarterly profit for Q4 2025 and provides Q1 2026 guidance, showing continued margin expansion. Analysts upgrade price targets. Goldman Sachs initiates coverage with a $90 target. JP Morgan raises target to $85. The stock trades in the $65 to $75 range as the market digests the new reality. Weeks 5-8, February 15th, March 15th. Silver reaches the $300 equilibrium price. The earlier calculation plays out. Now, why PAAS is a better choice than physical silver for this particular squeeze? I'm not saying physical silver is bad. It's ultimate insurance with no counterparty risk and can't go to zero. But physical has limitations. PAAS doesn't. Limitation 1, liquidity. If you own 10,000 ounces of physical and want to sell at $300 an ounce, you must find a buyer who will pay $300. A dealer might offer $280, taking a $20 spread. You may need to ship metal, insure it, wait for verification. Process takes days, onward weeks. With PAAS, you sell shares instantly at the quoted price. No spreads, shipping, or waiting. Your 847% gain is liquid immediately. Limitation 2, storage and insurance. Physical silver takes space. 1,000 ounces weighs 1,168 pounds. Storing at home creates security risk. Vault storage costs money. Insurance costs money. These costs eat into returns. PAAS shares exist electronically. Storage costs nothing, maybe a small broker fee. Negligible versus physical storage. Limitation 3, capital efficiency. To gain exposure to 1,000 ounces at $90 ounce, you need $90,000 for physical. To gain equivalent leveraged exposure via PAAS, you need less capital because the stock amplifies silver moves. A $30,000 investment in PAAS at 17 share gives 1,765 shares. But to be balanced, PAAS has risks physical silver doesn't. Risk 1, operational problems. Mines can flood, equipment break, labor strike, governments change tax policy. Any can impact past production profits. Physical silver in your safe has no operational risk.